Hi guys, welcome to this new session of CFA Level 2 Corporate Finance. Today we'll be covering another major portion of capital budgeting. So let's get right into it. The entire crux of what we'll be covering in today's entire session is mostly focused on evaluation of projects. So basic calculation of NPV, that is something that we've already done in the previous session. So your NPV calculation, everything you had from level 1, plus the expansion and replacement projects that we just did in the previous session. That is how we calculate the NPVs. Today's session is going to be more focused on how exactly do we evaluate the projects. If you remember from level 1, there are situations where we are dealing with mutually exclusive projects. In those situations, we have to be very careful in deciding where we end up investing our money because we have multiple alternatives, but the amount of resources, the amount of capital we have that we'll be investing in the projects, that is limited in nature. So we want to evaluate the projects so that we are investing money in the most profitable projects that are best for the shareholders of the company. So today's entire session is going to be focusing on the evaluation part of the project. So various techniques of evaluation, how one technique could give you certain benefits over the others, or in what circumstances could one technique be a better choice than the others. So the first thing we have to cover is projects with different lives. Now, if you remember at level 1, whenever you were evaluating multiple projects, and this would only be a concern where projects are mutually exclusive, because if the projects are independent, it doesn't matter if a project is for 2 years, 5 years, 10 years. So long as NPV is positive, it's giving me benefit. And if I have unlimited money, projects are independent, I'll invest in all. The main concern of evaluation comes into place when we are dealing with mutually exclusive projects. So projects with different lives is simply saying sometimes we are investing in a project that could be for 5 years. What if the alternative of that project requires an investment for 7 years? So I have project A 5 years, project B 7 years. Now at level 1, we didn't come across any such situation. Whenever we had to compare multiple projects, the cash flows were same in terms of the number of years for which the cash flows were there. So the life of project was same at level 1. But at level 2, life of project can be different. So in order to deal with these, we have two different approaches. Let's look at them. The first approach is least common multiple. Now, this is something that you probably heard of in your maths classes in school, LCM. The concept is exactly same. So let's take an example. Two projects, project A, project B. And I'm going to write down the cash flows. So at time 0, the initial investment in A is 1000, and let's say in B it is 700. Both of these are negatives because these are outflows. Then year 1, 2, and 3. A project would give you a cash flow of 300, 400, and 600. And project B will give you a return of 500 and 400. That's it. So project B is for 2 years and project A is for 3 years. Now we never got across this kind of question in level 1 because the concept was not part of level 1. Now the first thing, just to get the basics out of the way, let's calculate NPV of both. At discount rate of 5%. So if the discount rate is 5%, what would be the NPV of both? So if we just simply calculate the NPV of A and B, like in isolation, the NPV of A would come out somewhere in 166 range and B would be 139. This is the basic calculation. Now the problem in comparing these two figures is something very fundamental to time value of money. If you remember from quants level 1, the core concept of time value of money is that I cannot compare cash flows which are happening at different periods of time. As such, this NPV 166, this represents the present value of cash flows that are happening over 3 years, whereas 139 represents present value of cash flows happening only over 2 years, which means if I go for investing in project B, I'll have freedom of selecting some new project after 2 years. Whereas with A, my money will be blocked for 3 years. So because there is a big characteristic difference between both of them, I cannot directly compare NPV simply on the basis of mathematical logic. So that's where the first approach comes in. So this was just a recap how we used to have things in level 1. The first approach is least common multiple. Now, least common multiple approach says that out of the two projects A and B, one is for 3 years, the other is for 2 years, what is the LCM of the life of both the projects? So what is the LCM of 3 and 2? And from basic mathematics, least common multiple is basically what multiple of 2 and 3 are common. So the multiples of 2 are 2, 4, 6, 8, so on. And the multiples of 3 would be 3, 6, 9, so on. Wherever we get the first common multiple, that is the LCM. So the first common multiple would be 6. LCM approach says that instead of evaluating these NPVs, create a series for 6 years. Project A, Project B. And what I'll be doing is, for Project A, I invested 1000. Then I got 300. Then 400, 600. The moment at this point, at the end of third year, at this very moment, when my Project A is done, the LCM approach uses an assumption that I can reinvest my money in the same project again for another 3 years. It's not a very realistic assumption, but our purpose here is not to see if this method is realistic or not. This method is just giving a mathematical approximation of how we can compare these two. So the logic here is simple. The moment the timeline of a project ends, you will reinvest money into it at the same cash flows for 3 more years. Now, if I'm investing at the end of third year, so at the end of third year, I receive 600, I'm done. I would also be investing my 1000 again at the end of third year. Think logically. For 3-year project, my investment was at time 0. So for next 3 years, it should be at the beginning of the 4th year or the end of 3rd year, whichever you feel comfortable with. So 600 minus 1000. This is for the next investment. Just for clarity's sake, I'll write it slightly on the left side. 4th year, you get 300 again, 400 and 600. So this sort of represents the first time I invested money in project A. This represents the second time I invested money in project A. LCM approach is simply saying the moment your first cycle ends, start a next cycle of investing in the same project, getting same cash flows, same discount rate, everything exactly the same. Once you have it for 6 years, calculate NPV for the combined cash flows. Now keep in mind, combined cash flows means for year 3, this is 600 of inflow minus 1000, which means I can also write it as just minus 400. So now I have C01, C02, C03, 4, 5, 6, and this is CF0. In C03, we'll input the value minus 400. So my suggestion is just pause the video, give it a try, see if you can calculate the NPV of this combined series of cash flows. When you solve for this entire series of cash flows, you'll get an NPV of 310.9. 0.94 approximately. Now we'll do the same thing with B. B has a life of 2 years. We have to keep repeating our investment in B till we get to a point of 6-year investment.